What's going on, everyone? I want to talk about negative interest rates and what it actually means for you. So without further ado, let's get into it. So negative interest rates, why am I even bothered talking about it? Because it's not something that's hit the UK as yet. But exactly what I've just said there, it hasn't yet hit the UK. It is a potential for the future, but it's not definitely going ahead. So last year, in March 2020, the Bank of England cut the interest rates down from 0.75% to 0.1%. Now this is something that the bank will often do to stimulate the market, and it often gets more people spending rather than leaving the money in the account in order to accrue interest, because it's no longer earning a good enough interest to make it justifiable to keep the money in the bank. So why this has come up as a topic is because in February 2021, so just last month, the Bank of England said to all the high street banks and building societies that they've got 6 months to prepare for negative interest rates. Now this doesn't mean that it's definitely going to go ahead, that's what the Bank of England have confirmed, but it does mean that high street banks do need to be prepared for this change just in case it comes into effect. So what is negative interest rates? So currently at the minute, the bank will pay you a fixed element plus a variable amount in order to hold your money in the bank. But with negative interest rates potentially in the future, the bank will charge you in order to hold your money in the account. It won't be a lot of money every single year, but it's flipped around from them paying you to you potentially paying them in the future. So why does this happen? So back in the 1980s, interest rate was around about 16%, and then from the 1990s, it's been on a downward trend to the current rate, which is 0.1%. The reason why banks do this is in order to stimulate the market and increase spending. Because if you've got your money in the bank and it's earning a nice return every single year, you're less likely to want to spend it. Whereas if it's not earning you much money at all, you're more likely to just spend it, and it stimulates the market that way. So the first thing I thought of when I heard of negative interest rates potentially being released in the UK last February, or February 2021, I thought, great. I knew it weren't going to happen, but potentially the banks will be paying you in order to rack up credit card bills and stimulate the market. But of course that's not going to happen, because the interest rate that credit cards are charged at a lot higher than the base rate. Therefore, so they might come down a tiny bit, but more than likely they won't. So unfortunately, you still will end up with paying charges for any outstanding balances on your credit cards or loans. Mortgages usually track just a couple of percent higher than the base rate, so it is a possibility if the base rate goes into negatives that we could also see mortgages charged at a negative interest rate as well. But more than likely that won't happen, because a lot of banks and building societies in the UK have in a small print that they won't charge anything below zero, so therefore it's highly unlikely. If you're on a fixed rate mortgage, this obviously won't change until the term ends. Your rate will stay the same, and I believe that 9 out of 10 new mortgages are currently taken out as a fixed rate as well. So 9 out of 10 people won't be changing for a good couple of years. So savings, if you're anything like me and you like to have your savings in the bank, this is going to be an absolute killer when you find out this news that you could be potentially charged to keep your money in the bank. This is only just a precaution by the bank. It's not something that's actually going to go through. It's just something to help boost the market if it really does need it. The banks are more than likely going to go after the higher profile customers, more wealthy customers. So it's got a long way to go down to get to the likes of me and you potentially.
No, man, you keep it. You got some. You keep it. No, take this money. I don't want it. Take it. I don't want it.
So, you know, we've got just a couple of £1,000 in the bank. It's more than likely not going to impact you within the next couple of months, or you know, even 12 months after they roll it out. They're going to target the high profile customers first, but it will only be a small charge, even if it is charged. So there's a lot of different things that negative interest rates will impact. It'll impact the way companies are valued. It'll obviously impact your savings. It'll impact any loans you're taking out and potentially mortgages. So it is something that obviously won't be taken lightly, but it is something that might need to be done if the market does need a little pick me up. Obviously, because it's being hit massively by all the coronavirus issues that we're currently facing. But hopefully, even if it does come in, it won't be something that will massively impact you, because quite a lot of people already pay various different charges to the bank anyway at the minute. So you might pay £3 monthly fee in order to get a higher interest rate and a few little perks every now and then. So it's not something that will impact you massively, but it is just something to be aware of. So thanks a lot for checking out the video. Leave a comment down below if you want to get involved in any of the conversations. Drop a like on the video, helps the channel out massively. And if you're not subscribed, consider. So yeah, see you in a bit.